Hello, everyone. Today on the Final Bar, we're joined by Leslie Jouflas. Leslie always does a great job of breaking down the big picture, focusing on some of the tradable patterns and inflection points in the market. Certainly a lot of volatility today, but the S&P essentially ending the day where it finished the previous day. A lot of movement, though, in commodities, a lot of movement in interest rates, sort of a mean reversion from what we saw yesterday. We'll try to unpack all of that and more. Also, the latest sentiment readings. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the charts. We focus on the message of investor psychology and decisions and fear and greed and euphoria and desperation, all of those emotional drivers of investment decisions, and how price is an accurate reflection, I would argue, of the aggregate of all of those the emotional state of all of those investors. And today was really a choppy day. If you look at the S&P, it was a sideways day. If you look at the S&P, however, the moment you look one level below that, you start to look at sector movements, start to look at market cap tiers, you will find there is a lot of differentiation today. There are things that are working today and things that were not. In some ways, quite an unwind of the bounce you saw yesterday after the Fed meeting. Minutes were released after Powell's press conference. Yesterday afternoon was about rates popping up, about banks leading the way higher all of a sudden, and everything is just fine. Now all of a sudden today we get back to that reversion trade with cyclicals dragging down, with technology leading to the upside, and charts like the ARK Innovation Fund all of a sudden go from breakdown mode a couple weeks ago to all of a sudden pushing back above trendline resistance. We'll hit on as many of those things as we can. We have great guests on the show as always. I'm excited to welcome Leslie Jouflas on the show today. Just a quick update on our calendar. Tomorrow we'll be taking the show off for the Juneteenth holiday. We will see you next Monday. Coming up next week, we have Tony Dwyer as the guest I wanted to mention. Coming up next Wednesday, the 23rd. Tony comes from Canaccord Genuity. Always does a great job talking about the big picture. He's more of a strategist. Also, next week on Tuesday, the 22nd, we have The Pitch. The Pitch is now our monthly show where we have three strategists all providing 5 stock picks each. They each have a chance to pitch you their ideas, and then our moderator will talk through all the strengths and weaknesses of those picks. 3 great experts next week: Katie Stockton from Fairlead Strategies, Joe Rabel from Rabel Stock Research, and Mish Schneider from Market Gauge, who hosts her show, Mish's Market Minute, on StockCharts TV. So it should be a lot of fun. That's one of my favorite shows. I will not be moderating that one, but I'll be watching it with all of you because I enjoy it a great deal. Let's continue on with our market recap. So as I mentioned, this is one of those days when I talk with people that just look at the S&P or just look at the Dow or the E-minis, whatever particular thing that you do that's more of a macro thing, you're missing out on a lot of color that comes second level. And I would encourage you, if you are just trading, futures or some broad market index, don't, limit yourself by just looking at that for all the signal that you can. Look at things like sector rotation, look at market cap tiers, look at growth versus value, because that'll tell you the conditions which are resulting in the S&P doing a particular thing on a particular day. So the S&P was essentially flat. This was an unch day. This was a zero move of a day. However, the Dow was down 0.6%. The NASDAQ 100 was up 1.3%. The mid-cap index down 1.6%. The small-cap index down 1.8%. Now, obviously, financials, energy, materials, these are sectors that are a lower weight in the large-cap index and a larger weight in the small-cap index. And that's why you see small caps struggling so much as a whole. But that tells you a little bit about the characteristics. This is more about technology. This is more about the growth trade sort of re-emerging, in particular the mega cap stocks. Look at the average FANG stock, pretty decent move today, and that tells you sort of the conditions that we're in right at the moment. The VIX is back down below 18, around 17.7. Very quickly with other asset classes, the 10-year yield, coming back down yesterday. Obviously 2 p.m. was the release of the Fed minutes from this week's meeting. You saw the big rise in yields. All of a sudden, the 10-year yield is teasing 1.6% for the first time in quite a while. Today, sort of giving back all of that from yesterday, bouncing just above 1.5% there at the close, but overall, certainly stronger bonds with rates coming right back down. So the Fed effect that we felt yesterday is sort of right back to where it had been. The dollar index, by the way, is up to almost 25. Now, this is a chart that had been in full-on bearish mode for quite a while, and this stronger dollar environment. Well, let's go there very briefly. The stronger dollar environment that we're seeing is certainly a change of character. And I always want to encourage people, one of the most important things, or arguably the thing you should be trying to do, the three things you should be trying to do as an investor: number one, identify trends; number two, follow those trends; and number three, anticipate when those trends are exhausted, or when there's an inflection point. And arguably, we've now seen that in the dollar index. Before before this week, you certainly saw a rotation back to the upside, but here, you can see clearly on the daily chart of the USD this downtrend of lower highs and lower lows, testing the support level from January, and almost right about where we retested there at the end of February, right back at those levels, and then turning back to the upside. This doesn't include today's trade, and that actually updates at the end of the day for us. So the UUP shows you the gap higher that you saw. So that dollar index is going to continue to increase, and it really is completing that rotation. And stronger dollar tends to mean a lot of different things, but certainly would impact international stocks and U.S. versus non-U.S. stocks. So that's certainly something I would be paying attention to. Continue on just in terms of key themes. Commodities really felt it, took it on the chin today, with gold down 3% using the GLD as a proxy, silver down 4.8%. These really sold off after 2 p.m. yesterday. So while a lot of other things sort of mean reverted and sort of bounced back, gold and silver, precious metals accelerating to the downside today. So the chart of gold is actually fluctuating quite a bit. Let's go back to here and look at the chart of gold. We'll use the GLD right now, but you can see the rotation lower, and this is a big gap down. And while the breakdown had happened, arguably yesterday, when you saw the sell-off through the 50-day, the 200-day moving average here in red, and testing the 50-day from above, certainly indicated all of a sudden we've made a lower high. All of a sudden we're making a lower low, and this week put us below 175 on the GLD, which sort of completed that rotation. Today's gap down really cements that downtrend. You can see that the GLD all of a sudden in one day has gone from sort of, is this a viable pullback mode to it's not, it's more of a downtrend mode by the fact that the RSI became oversold. I think that's the chart to watch right now. We're sort of in that congestion range that we were from the end of April, downside support down to the March lows, which is around 158, 157.50, 158. It's another 8 or 9 points below where we're at right now. So that's sort of the downside potential that you see in the chart of gold, given the weakness that you saw today. But it's oversold, which means you should be looking for some sort of potential bounce. And I think that might be a key chart to watch through the remainder of this week into next week for sure. Cryptocurrencies, by the way, overall mixed, but the big ones, the most commonly referred to coins, Bitcoin, Ethereum, Litecoin, all down today, and really coming off during the equity trading session. Looking at sector movements today, so this was about growth working in a lot of ways, in particular technology. Came off a little bit there at the close, but overall, a nice move higher, up about 1.2% on the XOK, followed by healthcare, and we've talked about that improvement in some of the healthcare charts. Particularly, we've seen it in like equipment and supplies. It's not things like pharma and others. It's been some of those other groups, but some really constructive chart patterns that have come out of there. Utilities number 3, though, which is usually thought of as a much more defensive play, kind of a higher yielding, less volatile defensive move. On the downside, and I would say the overall story of today was less about some sectors that were working, but more about some of the sectors that really were not. This was a continuation of that rotation away from the value trade. We've talked about some of the issues with that. We talked about the 10-year breaking below 1.5%. We talked about the yield curve rolling over, and that continued to come down today with 2s minus 10s, that spread narrowing. as the curve is flattening, and that is going to weigh very much on financials, which absolutely felt it. I think that's probably the biggest story right now would be the sell-off in some of these cyclical sectors. And if you look at the S&P stocks that were down the most, this is on the your dashboard. I usually like to look at scooter changes, and then I like to look at the market movers here. That's how I usually make sense of things. But some of these charts have gone from looking I don't know, I would start to say okay to all of a sudden giving back a lot of this. This is Occidental given almost a bearish engulfing pattern. It's not quite there, but down almost 8% today. And it's still within the range that it's been for the month of June, but really giving all, yesterday it was sort of pushing above 30 and it felt like this was a nice breakout, sort of giving all of that back and more today, trading, closing below yesterday's low. Gold stocks certainly struggling, and this is after they all broke out in May, making new swing highs. We're looking at all the gold miners coming up and rotating higher. Now you have to consider that, I think, a false breakout. As you rotate back down, you see a gap lower today. FCX is another one in materials with down about 5%. And charts like this that all of a sudden are below their 50-day moving average, that I think is what differentiates a buyable pullback within an uptrend, which is the stock pulls back to its 50-day, the RSI hits a bottom around 40, which is what you saw here in March, what you saw here in January. All of a sudden, this looks very much different, where you have a break down through the 50 days, not able to hold support. The RSI gets below 40, which is all of a sudden more characteristic of a bear market phase. In a lot of those cyclical sectors, I think you're seeing breakdowns that suggest that this upcoming period is going to be a little more painful than you might have expected. And also, the FANG stocks may be the leadership you may be looking for. Let's take a quick break. We'll be back with my guest, Leslie Jouflas. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close as we focus on the charts. We focus on the message that the charts can tell us about investor decisions, about bulls versus bears, fear versus greed, demand versus supply. Arguably, the chart can tell us about all of those different pushes and pulls between all of those different opposing forces. We have fantastic guests on the show. We also love hearing from you, particularly with questions that are coming up in your process, analyzing your own charts. Shoot us questions that are coming up as you are using StockCharts. The Final Bar at StockCharts.com is our email. We're on Twitter at FinalBarSCTV. We're on YouTube. Just put a comment below the video that you're watching on the StockCharts channel. We'll capture all those questions. And early next week on Tuesday, we'll do another mailbag segment. We would love to answer your question on the air. Also, as a reminder, go to StockChartsTV.com. Use your email address, set up a free account. You can start watching all of our wonderful content, including our fantastic hosts on all our shows, and also great guests like Leslie Jouflas and many others. Use your email at StockChartsTV.com. Also, we are on all the app stores. Just search for StockCharts TV on demand. I want to welcome on my guest who's joining us once again on the show, Leslie Jouflas. Leslie's the founder of Trading Live Online. Comes to us locally here in the Pacific Northwest, always brings some charts that help me put the short-term movements of the S&P and other indexes into proper context. Leslie, welcome back to the show.
Well, thank you, Dave. Thanks for inviting me back. This is always such a fun show to do. So I've got just two charts today that I'm going to show you. We're going to start with this S&P 500. This is the futures chart, but you can look at the SPY or the SPX as well and find these same patterns. So what I am seeing here is that this market is just coiling up. And interesting, we had the FOMC announcement yesterday from the two-day meeting. A tendency around the announcement is anywhere from 1 to 5 days following that announcement, there tends to be a large move in the markets. And so all of this sort of coiling action that we're seeing just goes hand in hand with that tendency. If we look back to the beginning of April, you can see the upper dark blue trend line, then there's a dashed trend line above that. So that section from the beginning of April over to about the beginning of May, about a month, you can see the very similar sort of sideways with a little bit of an upward bias to it, a lot of doji closes. Well, now towards the end of May, we started that same sort of pattern, and we have had just doji close after doji close. And Dave just mentioned that we're getting, we're closing just a little bit above where we opened today in the S&P 500 futures. So the center line of the dashed line that you see in the center, you can see how the price has been coming down and testing that center line. So that 4,200 level is going to be now it closed just a little bit differently. This was the end of yesterday, so it looks just a little bit different, but not much. Today, the open and close the open just sort of hung on by its teeth to that center line. I think we're going to be seeing a bit of a down movement coming on the indexes. The NASDAQ is moving to new highs next week on the 22nd on your daily 5. I'm going to be showing you the patterns on that index with the Qs. But the S&P and the Dow right now are not making new highs, especially the Dow, and the S&P is lagging behind. So let me show you a few things that I've mapped out on this chart on where if we get that down move, breaking below 4,200, a close before below 4,200, I believe is going to be the start of the move, and then most likely down towards the more down towards that lower trend line. Now, if we kind of back up to February of this year, you can see a pink line drawn in. And then next to that, another pink line with the green line, and then you'll see these other pink lines. So what those are, they're showing you sort of the harmonics, the similar down moves that have occurred this year. So I like to use those to just sort of, estimate where it might go. We never know where price is going to go, but it can be a handy tool. Now, the one that has a little bit of the green line that Dave's got marked on that chart for me, that one is just showing us that that's an extension of the length of the initial pink line to the left, and it's extended by Fibonacci ratio of 1.27. So we take the length of that line, we multiply it by 1.27, and we subtract that from the high. That's the extension of that move. And the markets are always expanding and contracting. And so that one was a bit of an expansion, but you can see it held the lower part of the trend line that I now have extended up. So if we move back up the chart to where we are now, to the last pink line there, and so I was kind of projecting down, you can see that that's coming close to the first lower trend line. And that also, if it breaks that, it could dip below that, right around that 786 to 886 Fibonacci retracement of the swing marked in from the low of May up to the high. So that's what I'm looking at for potential move. So right around maybe 4,100, maybe dip a bit below it again. So that very lower trend line though, that's the one, the major one I'm going to be watching for support. Okay, now, and you can also see a few divergences there that happen in the MACD. So now let's quickly look at the second chart. And you'll see in this is the Dow Jones Industrials that completed an AB equals CD sell pattern back around the beginning of May, and it's tried to get to the highs again, and it just couldn't. It's broken the first short-term trend line and held the lower short-term trend line today as support. But like the S&P, break below that lower trend line, and I think that we're going to be seeing more of a down move. So that's it. That's what I have for today. So I hope you tune in next week on the 22nd to your daily 5, and I'll show you what's happening in the NASDAQ and the triple Qs.
Leslie, that's fantastic. I really appreciate you taking some time, especially with the S&P chart, to walk through some of your methodology. And I had not really realized the symmetry of some of those pullbacks that have very, very even trajectories. Leslie, listen, thanks so much for coming on the show. Be well, stay safe. Good luck on your daily 5 next Tuesday. All right.
Great. Thanks, Dave. Thanks for having me on.
That's Leslie Jouflas. Leslie's the founder of Trading Live Online, and I love how she talks through her methodology and explains the importance of some of these swings and some of these levels. As she mentioned, by the way, she's one of the guest hosts on Your Daily Five. She does a really good job with that show, which runs every day. She's going to be hosting the next one on Tuesday, June 22nd. So make sure you check it out. It's on StockCharts TV, and as she mentioned, she'll cover the NASDAQ, some other charts as well. We need to continue on with our show, going to Getting Sentimental. Wednesday into Thursday is when a lot of the weekly sentiment readings get updated. So I find it's a good time to revisit some of these sentiment indicators that we follow, just see what sort of changes there are. Sentiment for me, as we've mentioned on the show before, is sort of the third in importance. I think of price as number one, which is why we spend a lion's share of our discussion looking at price, looking at breakouts, breakdowns, trend line breaks, patterns. All of that, I would argue, is most important. If you know nothing else about a market or a stock, look at the price. The second thing is breadth, and I think that's a really important component. Most of, if not all of the great calls I've had, if I've had any over my career, have been recognizing when breadth conditions change, because a lot of times the chart of the S&P 500 or other major index will not change. It'll continue in a current way while the breadth picture really starts to change. 2007 is one of the most glaring examples of that, where the market pushed higher, but just the breadth conditions started to really deteriorate. And then the last thing that happened was the S&P itself started to come down, right? It was like the very last thing was people had gotten as defensive as possible, and then they started selling everything. And that's when the indexes really started to come off. So breadth, I think, is another very important one. Sentiment for me, though, is third in line, but it's also an important part of the process because it gets into more anecdotal sources of evidence. This helps you think about what people are saying, what they're thinking about, what they're worried about, what they're excited about. And while price is the ultimate gauge as to whether fear is manifesting itself in a price change, the sentiment readings a lot of times can tell you just the emotional state of a lot of investors and what, where you might see extremes, which have lined up, had been similar to previous market tops and bottoms. Having said that, we're going to use the sentiment indicator chart list. This is part of the morning coffee routine chart pack that is free for all StockCharts members. If you're interested in this, by the way, just go to your dashboard, look at your chart list. At the very bottom, there's a gray button that says Manage Chart Packs. If you click on that, you will find David Keller's morning coffee routine. This is one of the many chart lists that you'll have access to. We'll start with the VIX. And for me, again, the VIX is always interesting to see where we're at relative to previous market cycles. And, what happened is the last, 18 months have been a dramatic change, I would argue, in the way that you should be looking at the VIX, only because there was a period there of a while where the VIX had a certain range from, around 10 at the downside to 20, 25 at the most on the upside. If you look at 2019, most of that year was basically spent in that range. And if you could just identify where we were in those extremes, that told you overall the volatility conditions. That changed dramatically here in the first quarter of 2020. The second quarter of 2020, really into the fall of last year, was back into a new range with 20 at the low end and 40 at the upper end. Now, all of a sudden, in the last 3 months, we've gone back below 20. We have a bit of a spike there into the upper 20s in early May. This is on that May pullback, but after that, we sort of settled back into the overall range. What's interesting about this is the VIX hit around 16. This was last week. And this is one of the lowest levels that it's actually been since the February 2020 high. That was the lowest it's been since the 2020 high. 2 times it's been at that low of a level. The first was in mid-April, which was that last big push higher. And arguably, we really haven't done much. It was around 4,200. We're right back there today. So, since you hit that point, we're sort of in a sideways trajectory overall, even though we've chopped around a bit. And then the second time when we've hit that low of a level was here last week. And so the fact that we are, at extreme lows for the VIX, given the last 12 to 18 months, I think that's significant. That tells you the extreme, low volatility environment on a relative basis usually happens, closer to market tops than, earlier on in a phase. And I think that, in my mind is sort of a check in the warning column, where you're not seeing excessive bullishness, excessive euphoria, as in the AAII survey. This is a weekly survey of individual investors. comes out every Thursday. This week is just a tick higher on the bullish column, 41.1%, which is not far from where we were at last week, and also 2 weeks ago, just a little bit above this. We've really maintained a relatively stable bullish reading. When this gets above 50% bullish is when I start to use words like euphoric or excessive bullishness, or indicating conditions that are more likely to result in a market top. Here we're actually a little lower, and so it's actually interesting to note that as the S&P has made a new all-time high again in the last week, that the bullishness has not increased. Investors overall using the survey were much more bullish in early April when we first hit 4,200 than they are today when we're right back at 4,200. This time coming down from above. So bullishness has actually come out. The spread between the two actually is a little narrower than the last 2 weeks, about 15% difference from bulls to bears. And if there's any interesting signal, I think it's the increase in bears from about 21% to about 26% from last week to this week. Where you do get a really interesting reading is in the RIDEX flows and the name exposure index. The name exposure index is looking at money managers, and they're surveyed once a week to talk about if they're 100% or 200% long, 100 or 200% short, or 0% in equities. And it's a regular check-in on basically an equity allocation, just right at 100%, just below that at 90, 98%, 99%. So we are dangerously close to the euphoric levels that we've been a number of times actually recently. At the mid-April, we were back above 100% long. That tends to be more of an excessive bullish environment when money managers as a whole using this survey are net leverage long. So I think we're really close to a danger signal there. Where we are absolutely at a danger signal is using the RIDEX flows. This is telling you whether investors are in the more bullish or more bearishly positioned RIDEX funds. With this reading being at 0.07, it is literally the lowest reading that we have in the history of the data series going back for decades, and tells you that individuals are as bullishly positioned for this market than they ever have been. And for me, that immediately brings my Humphrey Neal contrarian hat out. It makes me think to be looking for signs of topping behavior. And perhaps, as Leslie Jouflas mentioned earlier, maybe we're starting to see the beginning of those breakdowns indeed. That's our review of the sentiment indicators called Getting Sentimental. We need to wrap the show. Go to the 3 and 3, 3 charts in 3 minutes. Here we go. Chart number 1 is the 10-year yield. It's very easy. Yesterday, the moment I saw rates skyrocketing, it was like, okay, it's a new game altogether. Rates are going up. Financials are going to crush it. Growth stocks are going to get killed. It was an obvious playbook started to look very clear until today, when we basically gave back all of that on the 10-year yield. We didn't get all the way back down to 1.5%, but certainly came off from yesterday. It was a great reminder of just not to get too caught up into the short-term moments. By the way, David Hunter, who was on my show, I think that was Tuesday he was on, we talked about sort of the Fed and implications of that. And, catching up with him after he was on the show, it's sort of, it moved like yesterday is a normal overreaction to the Fed, but in the end, it's going to be back to the overarching trend. And for him, it's, growth over value. And to his credit, today, we're sort of seeing right back to that, right? You see financial stocks really struggling, you see growth working, and you see rates coming down. So it certainly looks like, until proven otherwise, that seems to be the base case here. I mentioned in our segment Getting Sentimental about the name exposure index and the RIDEX flows. Again, I'm always very keenly interested when an indicator is at extremes, and the RIDEX flows certainly are that. The name exposure index also a rounding error away from being leveraged long, which I consider more euphoric than anything. And so we have these sentiment indicators sort of at bullish extremes, and that for me does not on its own tell me to just sell blindly or that the uptrend is over, but it certainly tells me to think more cautiously and be looking for breakdown opportunities. I'll tell you where you're not seeing a breakdown today is the ARK Innovation Fund. I have enjoyed, for some reason, talking about the breakdown in these charts, only because I think it illustrates a breakdown in a group of stocks and a style of investing that a lot of people just thought would go to infinity with no pullbacks. And I like the fact that there is a teachable pullback, an opportunity to learn about potential downside, but back above trendline resistance, back above the 200-day moving average. That's absolutely a chart to watch. Folks, that's our show for today. Thank you so much to Leslie Jouflas joining us from Trading Live Online. Great job breaking down the S&P. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.